Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note in the presentation we are using hypothetical computer simulated trades that are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke and I'm a trading performance and success coach with Blocking Your Success LLC, where myself and my team are here to help you win in life and in the market as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, not now, but in a moment, we're going to be going over the winning trade. But before we do, let me quickly explain what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to make money. Meaning that we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much better than they would be otherwise. Now, when you find that you're looking for more information as you're following along, simply contact us at lockingyoursuccess.com or post a comment in this video down below, and I'll make sure I get those questions answered for you. Okay, so let's take just a minute to talk about the markets over the last 6 weeks. We've had a 30% move down in the SPX, and that's the general markets. We had over a 40% move in the Russell 2000, which is the index we generally trade, which is absolutely huge. It's unheard of. We've never seen a move anywhere near that point level in that short amount of time. And on top of that, a lot of individual stocks. I mean, some of the individual stocks I've seen are down 60, 70, 80%. And, you know, that essentially means that a lot of people who have retirement portfolios and 401ks and so forth, a lot of them are down an awful lot of money right now. And, you know, this does happen from time to time. The market goes up, the market goes down. But one of the things you can do is you can offset your losses from longer portfolios and down moves if you're running the right type of what we call income trades. So let's talk about that for a minute. You know, a lot of times I'm told that income strategies or more market neutral strategies cannot make money in a downtrending market or through what some people might call a market crash. And, you know, as we demonstrated last week, we had a relatively market neutral calendar and we made money there. But one of the things that some people may say is, yeah, well, that was a subjective strategy and, you know, you knew when to put it on. Well, how about these strategies that are non-subjective? How about the non-subjective income strategies? And can they actually generate a profit through a down move of 700 points in a short period of time and then a 200-point bounce after that? I mean, that's hardly market neutral. And my answer to that is, well, let's take a look. And the trade I'd like to take a look at today is called the bearish butterfly. Now, the bearish butterfly is one of 3 primary trading strategies in our Rock trading system. And the strategy itself is designed to do well in choppy, downtrending market environments that are very volatile. But it also does well in sideways trending markets. It also does well in mildly uptrending markets. Really, the only time it doesn't do well is if you get these horrendous up moves in the index in low volatility environments. That would be the weakness of this particular strategy. But that being said, this is an income strategy that we do have a lot of students that trade this on a monthly strategy every single month non-subjectively, and over the long term, it's a wonderful performing strategy year after year. So let's take a look at the strategy. So in our example, the date is February 21st, 2020. The market conditions, if we were to look at these, let me see if I can find the price chart here, is, well, we've just gotten over this really nice long uptrend. We're kind of in a sideways trending market that's relatively wide. I mean, this is what, about 1740, 1750, down to about 1640. It's about 100 points wide, which historically is a fairly wide trading range. Now, really no signs of a problem. Our daily moves are relatively small compared to what it's been doing. It looks like the market's coming down. It looks like we're going to be still possibly in an uptrend for a while. So let me close this out. This is what our entry position is going to look like. Now, the bearish butterfly starts as what we call a butterfly. And a butterfly is where we sell, in this case, 20 short strikes at 1680, and I'm sorry, at 1660, and then we buy 10, 50 points out to the upside, and then we buy 10, 50 points to the downside. This is referred to as a butterfly. If we look at an analytical graph for a butterfly, essentially what we have here is we have a bullish vertical, if you know what that is, going in one direction. We have a bearish vertical in the other direction. This here is what we call our expiration line. So our asset price is along the bottom here. Our profit and loss is up the left side of the scale. And our expiration line is in the light blue here. And that is what the position would be worth if we were to expire it at expiration at any given price point of the Russell 2000. And this dotted line here is called our T+0 line. And this represents the value in the position, or the projected values for the position today. And then, of course, we have a black dot, and the black dot is indicating our actual P&L. Sometimes this line does wander from the actual P&L. That's just a modeling thing. And to fix that, we just have this little button here, and it kind of corrects it. So this is how a bearish butterfly is entered. When the market goes up, what we do is we scale in. So let's see, our short strikes are at 1670. If the market were to get to 1710, then we're going to scale in with another butterfly. If it gets to 1730, we're going to scale in with another butterfly. And then if it keeps going, we start rolling these butterflies to stay up with the marketplace. Now, to the downside, essentially what happens is we allow this to go 40 points under our short strikes, or you could say 10 points over our long strikes. But here we're at 1700, no, I'm sorry, we're at 1670. So if we go 40 points under that, 1630 is going to be our adjustment point, which is right about down here. And our adjustment is just to roll back at the money. Now, one of the cool things about this strategy is that you don't need to jump on top of adjustments the majority of the time. In other words, the market can substantially surpass our adjustment points, and we're not really that concerned about it. And that's really great, especially when the market's moving like it is, and you don't want to sit there and watch the market all day. In fact, we highly, highly recommend not trading these intraday and just picking an adjustment point towards the end of the day, or a time towards the end of the day, and make your decisions there and make your moves there. So this is going to be our entry position. This is a $50,000 planned capital position, and we're only starting with $9,000. If the trade goes bad, I wouldn't say goes bad, but if we have a difficult time with the trade, sometimes we get that $50,000 in it. A lot of the times, though, we stay below that number. The trade is entered 56 days to expiration. And it'll go until we hit either our profit target, which in this case is 30%. So if I have a $50,000 planned capital in this, 30% profit target on $50,000 would be $15,000, which is actually way up here. And if we get to 21 days to expiration and we don't hit our profit targets, or we happen to get stopped out in either of those cases, or we don't happen to get stopped out in either of those cases, we're going to reduce our profit target to $5,000, so that we can just get out of this strategy. Because if we're still at 21 days to expiration and we're not at our high profit target, then things aren't necessarily going as well as we'd like, and we're going to reduce that target. Just get out and move on and trade in the next cycle. So we also have an exit loss trigger here of 30% of our planned capital, which is going to be $15,000, which we couldn't even hit at this point because we only have $9,000 in the trade. But as we scale in, we'll get more money in this. So this is our starting position, and this is it's a slightly high volatility starting position. I mean, normally we're paying around $10 for this. We're paying $8.90, so the price is a little bit depressed. And it's surprisingly low given the kind of uptrending environment here. But anyway, this is our starting point. The market gives us what it gives us. So let's go to our first adjustment. So it's February 21st, 56 days to expiration. And this little X here turns the adjustment off. So this was the position prior to the adjustment. And what happened is, remember, the market price was up here at around 1680 when we started. We had a very substantial down move. we're all the way down into the 1570 range. And notice our adjustment point is up here at 1620, so we are almost 50 points past our adjustment point. Meaning that this was actually an unfortunate timing of a down move, because we were almost at our adjustment point before, on the day before, and now we get a very, very big move. So now we're substantially past it. Not a big deal. Not a big deal. We're still up $1,200. This is what our position looks like prior to adjustment. So the adjustment's really simple here. You sell a butterfly, you buy a butterfly. So we sell out this 1660. We buy the 1570s at the money. When we roll back, we go at the money. And this is our new position. Everything is looking good. If you look at the charts here, we ended up having a support break, right? We came down to, like I said, right near our adjustment point on the butterfly. We ended up having a support break and a pretty big move today. So, and now we're centered here at about 1570. So if we go to our next day, or our next adjustment, which is 2 days later, the 27th, we're in a situation once again, let me turn off the adjustment. We're in a situation once again where we've exceeded our adjustment point. So 1530 is our adjustment point. We're at 1520. And this is what the position looks like here. We're just slightly outside the tent. What we're going to do is the same thing. We're going to sell this butterfly out. We are going to buy at 1520. Let's show that happening. This is going to be our new position. And we're back near the center of the butterfly. So let's go to our next adjustment point, which happens to be the very next day. So here we are. We get another large move down. We have an adjustment point at 1480. Market's at 1450, 30 points past our adjustment point. So looking at our graph, we're going to just roll this down to at the money, which is going to be, let's see, for 1455, that's exactly halfway between 1460 and 1450. We don't generally use the 5-point strikes, not for any particular reason other than they're a pain in the neck to have on our graph here. It just makes things really wide, so I like to do 10-point strikes. And if we do this, we come down to 1460. This is our new position here, back near the center of the butterfly. Let's move on. February 28th. March 4th, we get a really, really large bounce. If we go to the price charts here, you can see we were all the way down here to 1450. Now we're all the way up to, gosh, what is this? It's like 1525. That's like 70 points. That is fairly large, and it's just after we rolled it back. So our first adjustment point would be here at 1500. Our short strikes are at 1460. We add 1500. We also add another third. This position is done in thirds. We add another third at 1520. We actually have a roll point at 1530. So what we do here is going to add butterflies at 1480. We're going to add butterflies at 1500. So let's take a look at this. This is what we look like when we're fully scaled in. And this is what our analyzed graph looks like. If we continue to go higher, what we do is we take off these lower butterflies and we put on upper butterflies. And this looks awful narrow. It's just because the graph is really spread out. This is what it looks like on normal size. So here is our position on March 4th going into the next day. So let's go to our next adjustment. 2 days later, March 6th, we look at our price chart here. We had a pretty hard down move on the 5th, but that didn't create any adjustments. It was still within range. And then we had a very big move here on the 6th. That blew through our entire position. And that being the case, what we're going to do is we're going to sell out the position that we have on, and we're going to start again at the money, because we blew through the backside, which is very rare to do that in 2 days. That would, then the market's really moving at that point. We haven't experienced that since 2008. We used to see, we trade this. We've been trading this this strategy for a long time, and we did trade the 2008 market debacle, the market crash in 2008, early 2009. The strategy did fantastic in that time frame, and the price movements here are even bigger. So anyway, this is going to be our new position here. And this is looking good. Notice, as we roll back, typically what happens is we start taking money out of the position. So let me go to our next adjustment. It's going to be 3 days later on March 9th. Now the market's really picking up. This move here in the Russell, 125 points in 1 day. Before this, the highest move we've ever had in a single day in history was a little over 60 points. It was like 64, 68 points. And now we have a 125 point move in 1 day. That is insane. That's completely insane. And if we take a look at this, we are way outside our adjustment point. Our adjustment point's back here at 1390. And we're close to 1320. That's almost 70 points. 70 points under adjustment point. But again, you don't have to jump on it in the middle of the day. Everything is doing fine. So what do? Well, we close this position out and we roll it back to at the money. Same thing. This is going to be our new position right here. And it's looking fine. So let's move on. 2 more days. Now at March 11th. And we're down below our adjustment point once again. So what we're going to do here is the same thing. We're just going to roll back to at the money. And let's pick this up a little bit. Let's go to the 12th. So we had a 95 point move in 1 day. That's probably the second biggest day we've ever seen in Russell history. And then we have a 135 point move after that, which is even bigger than the move before. The moves are getting insane here. So here is our position prior to adjustment. Notice we're just a little bit beyond our adjustment point. Our adjustment point is 1220. The market is now at 1130. That is 90 points past our adjustment point. So let's take a look at what we have here. This is our position. What we're going to do is we are going to roll this back to at the money. We're just going to sell out of this butterfly. And we're going to buy at 1130. So here is what our position currently looks like. At this point, we literally have no risk in the marketplace. As far as taking a loss from our initial capital, of course, we can lose any profits that we have, and we are going to lose the profits that we have with the moves that are coming up. But so far, we are doing very well, and certainly not hurting at all. So here we are with 36 days to expiration. If we were at, say, 21 days to expiration, we would definitely consider possibly exiting this out. And one of the reasons that we would do that is just because, well, the market's moving like we've never seen it move in history. And if you get up to a profit target number, not a bad idea to get out. I would even argue that this wouldn't be a bad idea just to stay out at this point. But let's move on. So it's March 12th. We go to March 16th. And once again, 144 points in the Russell. Crazy moves, crazy. But we are down 30 points past our adjustment point. Roll back to at the money. Here we're sitting, and now we're only up 1,000, so we are starting to get hurt a little bit by the magnitude of these moves. And the implied volatility is so high now, it can't increase much. I mean, I suppose it could go higher, but it generally doesn't go much higher than 80 on the Russell, even in the market crash 2008. So Anyway, here is our adjusted position back to at the money. Of course, the analytical model software cannot even, if you haven't noticed, it can't even project a normal T+0 line here. The implied volatility is so high and the market movements are so big right now that the analytical model is essentially breaking down and not even making projections that are realistic. Let's go to the next adjustment, which is 2 days later, the 18th. The Russell continues to fall. It is now down another 125, down to 980, well past our adjustment point. Time to do our rollback. So we're just going to come in here. Actually, we'll show you the analyze. That's our analyze graph. Let's do our rollback at the money. Here's our analyze graph. Everything is looking fine. Let's go to our next adjustment, which is the 24th. So we're actually able to stay in this for a little while without an adjustment. I think it was like 6 days. That's so far in the trade, that is crazy. We get an 82-point up move in the Russell. That's the biggest up move we've ever seen. Now, one of the cool things about doing a bearish butterfly, especially in these conditions, is, and not trying to be on top of the market, we had an add-in point here at 1020. We had an add-in point at 1040. We had a roll point at 1050. We had a roll point at 1060. We had a roll point at 1070. What did we do? Nothing. We just sat and did nothing. But what we are going to do is we're going to consider where those points were, and we're going to just put ourselves in the position we would be in had we made all those adjustments. Okay? So at the end of the day, whoa, I'm way past my adjustment point to the upside. No problem. No problem. What we're going to do is we're going to remove this butterfly, and the position we would be in had we made all the adjustments is this position here. We'd have a set of butterflies at 1040, a set at 1060, a set at 1080. And this is what our position would look like. Fully scaled in bearish butterfly. Again, because of the point moves, the software automatically narrows down the tent. That's 10's the way we usually look at this. And this is what it would look like normally. So that is our adjustment position. So that is on the 24th of March. If we look at our price charts here, you can see we came all the way down here, and this doesn't look like that big of a move because of the magnitude of the move down, but this is pretty big. I mean, we're at 980 to 1080. This is like 100 points up in the Russell, and that's a lot. So let's move to next adjustment, which is the very next day. We get another very large up move, and again we exceed several adjustment points. This is starting to hurt us. Usually if you're going to lose in a bearish butterfly, you lose in the impending bounce. It's very rare that you're going to lose in any kind of a down move. But if the bounce does get too out of control to the upside, we can sometimes take a loss on the upside. We are drawing down a little bit, but nothing to worry about. $15,000 maximum loss. We're just barely drawing down. So anyway, we did exceed several adjustment points, and we're not going to worry about that again during the day. We're just going to check at the end of the day and say, oh yeah, this is the position I should be in if I made all of my adjustments. We'll remove what we don't need, and we'll just add in where we do need. In this case here, we actually removed the whole position and come into our 1100, 1120, 1140 butterflies. Here is what the new position looks like. We go to the next day. We get another 61 points in the market. Right? This thing is flying. This is going to require another 2 adjustments. So we're going to take off these 1100s, we're going to take off these 1120s, we're going to put them at 1160 and 1180. Do that. This is our new position here, and we're drawing down a little bit, but here's the great thing right now. Implied volatility is so high, it's insane. Usually if we got this kind of a price movement and low implied volatility, we'd be hurting. we'd be down near our maximum loss. We'd probably have $50,000 plus in the trade with that type of a move. But in a high implied volatility environment, these things react fantastically well. And considering we got a 200-point up move in a strategy that's essentially negative delta, then and we're only down a couple $1,000. I mean, that's a good deal. So this is Thursday, and then our following adjustment. There's no other adjustments. So let's just go at this day by day here. So this is Thursday. We get a bit of a settlement in the market. It doesn't take long for things to come back, right? We actually had a little bit of a drawdown here with a 21-point down move, but no issues. If we go to the 30th, where we go from down $4,000 or $5,000, whatever it was, to $730 positive. This is the power of these. I don't have any money in these, or very little money in these butterflies, and these are going to gain money tremendously fast when the implied volatility shifts out of the marketplace. And this is what's happening here, right? It's starting to shift out. So up $730, or almost $5,000 or $6,000 in one day. And then on the following day, we actually close the position out. So let's see where that goes. Let me take off our adjustment here. So on the following day, we get a down move, but our implied volatility drops despite the fact we get the down move, and this is up $8,430. And because we're 17 days to expiration, and the fact because it would be crazy not to get out if the market was moving this fast and you weren't anywhere near a profit target. For those two reasons, we are out of this trade at an $8,430 profit. And this does include commissions, but it doesn't include the exit commissions. The exit commissions are going to pull off another, I don't know, $30 or whatever off the position. And that worked out extremely well considering the conditions. Because we've got a 17% return in 39 days in an income trade through a down move of over 40% in the index, followed by a bounce of over 200 points. That's crazy. And that's also why I love the bearish butterfly. This episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get the information that you need about our free trading performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or any comments about anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonuses on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any questions you may have. Thank you, and we'll see you on the next winning trade.